Okay, I think we're good. Hello and welcome, everybody. My name is Jason Allen Jankowski. This is my regular monthly, semi-monthly training for the Pro Traders Toolbox. This is where I like to take a little bit of extra time for those of you that have recently purchased a copy of the Pro Traders Toolbox, or maybe who already own a copy and just want a little refresher on it. I want to say thanks for coming, and please put any comments or questions you've got in the Q&A box, and we'll spend as much time on those as we need. What we want to do today is provide a little bit more deeper insight as to how best to work with the signals that the toolbox generates. Those signals, it's important to understand exactly how the toolbox is thinking and what those signals might represent. Using them together, using them congruently, takes a little bit of time maybe to kind of get a real good feel for, so that's what we want to spend some time on today. If you are someone who is just attending because you want to learn more and you don't own a copy of the toolbox yet, that's fine. You know, if you have questions about it, that's good. You know, if it's a little off topic on training, you want to know more about it in detail, that's fine. If we got time, we'll do all the best we can to help you. But on the website, on my website, there is a whole page devoted to the Pro Traders Toolbox. There's a bunch of introductions, descriptions of the platforms it runs on, that kind of thing. So you're always welcome to go there as well if you'd like to get a little bit more detail. There's also the user manuals, little PDF files that tell you how to use the product with the different platforms, so you're welcome to look at those as well too. Okay, let's get right to work. First thing, as always, thanks for coming, guys, but I never know who's listening. Trading in foreign exchange is considered a risk investment. It's not suitable for all investors at all points in time, so you want to carefully consider if trading is right for you in light of your personal tolerance for risk, your financial tolerance for risk. People can and do lose money. It's rare cases. They might lose more than they invest. So you want to make sure you're absolutely ready, willing, and able to assume the risk. Also, opinions, market data, everything we talk about in here is considered opinion, so it's subject to change at any time. Now if that's good, let's go ahead and get right to work. We might have a couple of I noticed a couple of new listeners in here, so I want to just tell you a little bit about me. I'm the guy that wrote this toolbox. The Pro Traders Toolbox is my proprietary method of approaching the marketplace. It's a total of 22 algorithms that all work congruently together inside the market, and it'll work on any market that you're interested in. Stocks, equities, of course, futures, options, and foreign exchange. Those details about how it thinks and more about the toolbox itself, as I said, you can get from my website. But I wanted you to know a little bit about me. For those of you that are regular listeners, you've heard all this before, but the Pro Traders Toolbox is a proprietary method of how I think put into mathematical or numerical terms. When I started in this business in 1987, I've been trading my entire life, and I started as a customer, just like you did. And in that time frame between when I first got started and now, I went through a process of change and growth that most people will never go through. And I believe that's one of the reasons why I'm a net winning trader. If you follow me for any length of time, you'll see that I pull more money out of the market than I lose consistently net all the time. And as a matter of fact, I could be considered one of the top performers over time. If you look at my performance over a 2 or 3 or 5 year period of time, it's usually right up there with some of the best performance that you'll get publicly traded funds, hedge funds, etc. And there's a reason for that. Now, what I had to learn in order to become that successful was absolutely, without a doubt, debilitating beyond belief. And if you're like most people, you're developing your trading approach with a degree of frustration and pain. Everyone does. Because the markets don't function the way that we first believe them to function. And it's very common for you as a trader to think that the more you learn and study about the market, the easier it's going to be for you to do this. Well, if you've been trading for any length of time, you've probably already discovered that the more you learn about the marketplace, the harder it is to make money. In fact, it's the absolute opposite of what's required to win. And I discovered years ago that psychology is 95 to 99% of this business. If you're not taking time to work on your personal method of trade psychology, your personal thinking process of how you reach conclusions, if you're not putting equal or greater amount of time into developing that area of your approach equally as well as you would your market approach, then it's my opinion that you're just going to end up losing money anyway. Trading, the psychology of trading cannot be underestimated in this business, in my opinion. I learned that the hard way. If you're interested in learning more about my point of view, if you're new and you haven't really seen everything I have yet, you're always welcome to check out some of the books I've written. They're all available on Amazon or in bookstores. I also provide regular commentary every week, every Friday. You can come to my free broadcasts on Friday afternoons. I show you my results in the market, win, lose, or draw for that week using the Toolbox. All the other programs and products that I offer are available on my website. If you don't have that, I have all those contact information available at the end. And the reason I told you all that is because the Toolbox is unique in a method of thought. It's doing something that other people don't do or don't even think about. The reason it has better quality signals and can give you a lead on the market more often than not if you know how to use it is because the Toolbox is looking for the loser in the market. It's not trying to make money by crunching numbers. It's trying to find a place where the losing trader is likely to get positioned and then take the other side of that trade. So when the loser is getting ready to buy the market, that's where the Toolbox is saying it's a good place to sell, and vice versa. In my opinion, that is unique. There are very few methods of analysis or signal generation that use that kind of concept. And the reason most people don't use that kind of concept when it comes to trading is because they don't know any better. They really do believe, everybody out there that you are going to be exposed to, 90-95% of them for the most part during your trading career, the people you're going to talk to or listen to or attend webinars or buy their products or services, most of those people, the vast majority, almost all of them, really believe that the way to make money is to crunch numbers and get better at analyzing the market. In fact, that is exactly why they're losing. That the markets do not move based on those things. The markets move based on something called order flow. And if you don't understand the relationship between the buyer and the seller, the probability of you making money net is very low. And the Toolbox is an excellent tool for one very important reason. Because first of all, it's going to help you get positioned against the real order flow in the market more often than not. And it's going to help you shorten your learning curve to understand the real nature of how prices move and how to participate to take advantage of them. That doesn't mean that you have to evolve any further than that. Some people have used the Toolbox, and that's all they use, and they've been using it for years, and they love it, and they do well, and they're happy with their results, and that's as far as they want to go. They just want to keep using it the way they know how to use it. Great. Other people begin to understand that the Toolbox is just one method of thinking, and it is not the only one, and that they may be more congruent in their own process by using the Toolbox in addition to other things that they might use, which is fine. There is no right or wrong way to make money. And the reason I wanted you to know a little bit about me and a little bit of the background of the Toolbox is because when we talk about using the signals, you have to understand why the Toolbox is thinking what it's thinking and why it's putting signals there. In any case, you still have to bring to the table a high degree of personal discipline in order to get the most from the signals, and you have to study your own psychology in order to win consistently anyway. So the Toolbox is a great way for you to shorten your learning curve, get on the right track, and learn to stay there. But it's not the end-all and be-all of making money in the markets. It's a fantastic tool, and you want to learn how to use it. If you don't currently know anything about the Toolbox or how it works or whatnot, as I mentioned, a lot of stuff on my website. You're welcome to have a look, and of course, I'm always available to answer your questions too. Okay, that being said, let's go ahead and get right to work. A couple of things that I want you to be aware of right away. Of the Toolbox, of the available platforms that the Toolbox runs on, there are some unique things you need to know. First of all, if you're using it on Trade Navigator, you need to have access to Genesis Financial Technology support. There's the telephone number. If you don't have it, there's their website. If you're using it on TradeStation Multicharts or MT4, I think recently we've had some new owners using it on MT4, I think. Installing the Toolbox is done by downloading and installing the files provided by Code for Traders. So if you have any questions about the installation process or how to confirm that the toolbox is properly working for your platform, you need to contact Progster. He's the guy at Code for Traders that does the work for you. That's Steve, and he goes by the word Progster. That's, I guess you call that his hacker name. In any case, you want to go ahead and write this data down in case you need it. Genesis, you want their support number and the website, and of course Code for Traders if you're using it on the other platforms. If we then were to go to some very important basics about making sure you're using the system right to begin with. First of all, on Trade Navigator, don't use the template designed for the currency pair selected. And the reason you want to do that is that the stops, there are suggested stops used by the toolbox. You don't have to use those stop levels, but they're suggested. If you're using them, and you use, like, let's say you use the euro template on the dollar-yen, your stops are going to be off. The algorithms are slightly different for each pair anyway due to the nature of those markets. So if you use the euro template while trying to get data on yen as to where to trade yen, you might end up with some erroneous signals that really shouldn't be there. Also, you want to get the maximum data set that Genesis can give you. You want to set your maximum days for intraday data to 200. The default is 10 days. You don't want that. You want 200 days or more for intraday data. And the reason you want that is that the more data you provide the algorithm, the more accurate the signal. On TradeStation, those things are true as well. You want to use the right template or screen for each pair, but the TradeStation setup is different. They have the maximum data available as default anyway, and they have something called the radar screen, which is a real nice benefit. It allows you to look at more than one time frame at a time, whereas on the other platforms you have to toggle back and forth between time frames. Now, it's up to you if you want to use the radar screen, but you don't need to use it to get signals from the toolbox. It's kind of neat when you understand the relationship between multiple time frames and the signals as they're generated on your working time frame. It's nice to be able to look up and down the box, so to speak, and see what the other time frames might be doing as well. It just saves you some time on your scanning. On multi-charts and MT4, the page creation and back testing features are a little more useful. If you create profiles in MT4, it'll save time and speed loading the toolbox on multiple time frames. Like on my profiles on MT4, I have it set up so that each time frame for the pairs I watch is one profile. So, I'll have the toolbox running on the pairs I'm trading on the 60-minute time frame. Then I can toggle to the next profile, which is a 120-minute time frame. Each platform has its own method of calculating and combining data for you to view. However you want to use it is up to you, but there's some nice features on each of them. In my opinion, it doesn't matter which platform you use it on. It only matters that you understand the signals and how to work with them together. Personally, I like using the Trade Navigator platform because I just like the layout of the screen and I like the symbols. I've used the toolbox on the other products, TradeStation, Multicharts, and MT4. It's identical. It's just I prefer the Trade Navigator, so I usually do my training and teaching on the Trade Navigator. So regarding the signals themselves, the baseline of what you want to learn, and I'm going to go walk with you through this in just a minute, is you're looking for a relationship in the marketplace, which I call conflict and congruence. If you guys, I don't know if any of you guys out there read my book, Time Compression Trading. I don't know if you guys have read it, but in there I make a very important point, and I think it's real critical for you as a trader to understand that you need to look at multiple time frames in order to understand the true nature and structure of the market. And when I say multiple time frames, what I mean is in most cases, most time frames, most of the time, in most markets, the winner, the guy that is making the money consistently, the person who is earning money consistently in the marketplace is on a time frame that's 60 minutes or higher. The winners are on the larger time frames. The losers, the guys that are losing money consistently, day in and day out, week in and week out, month in and month out, those guys, as a group, are trading on the smaller time frames. What you want then is to understand that when the small time frame is seeing its time to buy, the larger time frames are looking for a place to sell. That is the relationship you need to look for. So when the toolbox says, on a high time frame, we're getting a top is trying to form, if you're getting sell signals on a high time frame, it would be good to see the lower time frames, like the 5, 10, 15 minute, that kind of thing. Those guys are seeing buy signals. So that's called conflict. Congruence has to do with many high time frames seeing the same thing. In other words, on a larger time frame, if you have, say you're watching the 60-minute, the 120, the 180, 240, and the daily, there's 5 high time frames right there. And your 60-minute chart gives you a reason to sell. There's a sell signal on a 60-minute. You would then want to look at the 120, 180, 240 daily and see if you get a congruent signal. You get another sell signal. So maybe you'll get a sell signal at 10 o'clock in the morning on a 60-minute chart, and then at 11 o'clock or noon, the 180 has a sell signal. Or at 11 o'clock or noon, the 240 has a sell signal. You're looking for congruence. That's what, in other words, equal or better signals from more than one high time frame is called congruence. Larger time frames control the markets. So you want to lead with the larger time frames whenever possible. In other words, when you're looking for a setup to do something, the more information you can get from the larger time frames that give good clues as to what's most likely coming next, the better. Now I'm going to use a few examples on the toolbox running on Trade Navigator. So guys, help me out here. Would you let me know when we've got Trade Navigator? You should be able to see Cash Euro up here real quick. Can you guys see this? Okay, guys, can you see this? I don't see anything coming in for yeses here. I just want to make sure we're still, because sometimes we get a time delay here. I want to make sure that we've got screen and sound, and you guys can see that right now I've got Euro up here. Okay, a couple of yeses coming in. All right, we might have a little delay today, guys. If that's the case, hopefully we'll be able to work around that. Okay. Now, on Trade Navigator, as you can see, I've got some notes of my own up here, right? Now, for those of us that are following along in real time, here it is, the 18th of July, 2013. And last week, the Euro traded down to the low for 2013. And those lows I've got listed here with separate green lines here. This is why I call these support lines. Low opening range for May 2013, the traded low, May 13, low daily close for 13, and then the traded low for 2013, the whole year. That's what I consider the support area. I would like to see some buy signals coming on over here. And we did a couple here and there, but what we're looking for here, this is a 60-minute time frame. So I'd like to start my analysis on a 60-minute time frame. And I have some other lines up here for resistance, and I've got some notes over here. You can see I've already put all this kind of stuff in. But the toolbox itself is putting signals on that are from the buy side. These are buy signals right here. These are what are called trend buy signals. And this one right here is a strong trend buy signal for the most part. Now you notice that the toolbox is putting signals on both sides. This X here, this is an X reversal, an exponential reversal. When you see that, you know the market's trying to form a top. This little blue box next to it is a negation factor. Now the way it works on the other platforms is you would get a T down here underneath the bars that are buy signals, right? A capital T would be your strong trend buy. Your X would be an X, and then if the X was negated, you would have another X next to it that was blue. right? You guys have all seen this if you're using MT4, TradeStation, etc. Trade Navigator, I like using it with symbols, me. That's why I like using it. And here's what I want you to understand. If we look here at this particular setup, the 60-minute on Euro, this is giving you signals on both sides of the market. And you can see the suggested stops down here. Here's the little green dots underneath the buy signals and the red dot above the sell signal. And you'll notice that almost all of the green bars, or green dots, or green buy signals, if you would have taken them and held somewhere, you would have had some sort of a lead at some point. You haven't been stopped out yet on your recommended stops. In other words, if you bought it on any one of these signals, at one point you had up here, you had an open trade profit of some amount, right? But the only one that hasn't worked is the last one that just came on here at, midnight or whatever, this last 24 hours. So what am I trying to tell you? What I'm trying to tell you is, if you're a conservative trader and you use the signals on a 60-minute, 120, or larger time frame, run a wider stop. Just trade smaller and run a wider stop. Most of the time, you'll get some kind of a lead. What you do with that lead is determining how well you do. Now, if we were to stop right here and then go through multiple time frames, I want to give you an idea about this relationship between conflict and congruence a little bit. So we've got the buy side. The market is coming off this low, and it's saying you might want to get long. Well, you're coming off the 2013 lows. I think that's probably smart. At the same time, the distance the market moved from the lows up to the high prints was enough to suggest that a reversal was probably likely of some amount. If you would have sold it on that reversal pattern, you'd have a lead as well. If we look at the 120 time frame, you'll notice that we're getting a congruent buy signal right here along with the latest round of buy signals. In other words, this buy signal is congruent with the 60-minute roughly in that area. If you look at this bar, which is the 10 o'clock bar, look at the bar behind it and the bar after it, that area there, if I were to draw a little circle around it, that area there, combined with the 60-minute chart, is right here. The last round of buy signals are fairly close. You see what I'm saying? If we look at the 180 chart, we're getting good congruence. The 180 chart is saying you got a buy signal right here, right now, that's congruent with the last day or so of the 60-minute. If we look at the 240, we don't have anything in that same area. Now, before you get confused, looking back in time, the important issue here is to look for congruence. In other words, the fact that the 240 suggested a sell signal into the recent highs right here, right, is great. But if you look at the 60-minute chart, there wasn't anything there. And on the 120, there wasn't anything there. It came in a little early and then was negated. And on the 180, we had a sell signal early and then it was negated. So what you have here is you have sell signals coming on late in the move to the 2013 lows, and on one that maybe gave you a nice lead on the 240, it was still late. You see what I'm saying? In other words, you got to use some common sense here and ask yourself, when the market trades down to the lowest price it's been for the entire year, is that time to sell or is that time to buy? Well, if you look at the congruence factor on the way down, when the market finally hit the lows and went into the lows for the year, we started seeing buy signals on a high time frame. Here's a 180 buy signal, another one at the lows. On the 120, we didn't see anything. Oh, we did the 180, and I think on the 240 we're a blank as well, right? And then if we look at the daily chart, the buy signals came on later, right? They didn't come off the low; they came on later. So what am I telling you here? Well, what I'm telling you is that if you are using some common sense and realizing here we're back at the 60-minute on Euro, if we're using some common sense And we're saying when the market trades down to a significant low price, a yearly low, a 2-year low, a 4-year low, and it's sitting there, it's probably time to buy. It's not a sell at that point. It's most likely time to buy. Do we have any signals on the buy side from higher time frames? If you see 1 or 2 signals show up on the high time frames, that maybe it's time to take a small position maybe. Then as the market moves your way, now you're going to get late signals from the trend that is ending. So the downtrend is starting to end. So which side of the market do you think is more likely? If you still want to be a seller on lifts, that's fine. You might end up taking a little bit of heat. If you want to be a buyer now that the market's moved off the low, that's okay too. There's some good reasons to go long. What I'm saying is that the toolbox is going to give you signals on both sides of the market, and it expects you as a trader to understand the relationship between what is most likely in relative nature to the actual signals. It doesn't mean that the signals won't work. It means you'll get a lead from one side or the other. What do you do with that lead? I mean, if you didn't get a signal at the bottom, but you had presence of mind to go, okay, we had the 180, had some hook reversals, so we'll take that. Excuse me. So we'll go long. You had the presence of mind to try to buy that dip. Then you get sell signals coming on. Well, that doesn't mean you have to liquidate there. Some people use it for that reason. They go ahead and take it off. Maybe the thing to do is to roll a break-even stop and let it work for another couple of bars. If you look at, the higher time frame, let's say the 240, and we look back over here, this is the high for the quarter, and it's saying you're looking for a top in here, then if you would have taken that, you would have had some nice lead. Now the buy signals come on. That doesn't mean they're bad buy signals. These couple of buy signals here gave you a 60-point lead before the downtrend resumed. This reversal here that said, okay, it's all over, that's it for now, there was a solid 100 points in there at some point as a lead before the market came and scratched trade or took it away from you. So look at it this way. When you're looking at the toolbox signals, are you bullish or bearish? If you're looking at it from a more bullish point of view, wait till the toolbox gives you a buy signal before you buy the market. See if you got congruence on multiple time frames. You may buy and get a nice lead. It still may be a down market at that point, but that's not the point. The point is you're looking for a place to buy the market. The toolbox is saying if you're a bull, here are some great places to buy. That doesn't mean that it's all over and the market's going to reverse. It means you can get a lead, so it doesn't cost you much to find out. Same is true with the sell side. You look at the market being up here at the 134.5 area, 134 area, right? And coming all the way down here and then retracing quickly. There's a lot of people out there that say this is a bear market, a sharp rally in a bear market. And if we look at a fib number, we go from here to here. And we retraced, this is a perfect fib place to sell, at 50% to the 61.8 or 2/3 fib, I call it. That's the place to sell, at the 131.50 area. So they get short. Wonderful. Toolbox said you might want to try that. Here's a 240-minute price chart. It gave you a sell signal. At the end of the bar, you would already had a lead of it, of 100 points. But, the point I'm getting at is that, if you're looking for a sell signal, it would have helped you time it fairly well. It doesn't mean that the market is going to cooperate with the signal 100% of the time. What it means is if you're bullish, here's some great places to go long. So let's go up and down the higher time frames and see if we get any place else that's congruent with some of those buy points. Because if they are, we get 2 or 3 high time frames that say it's time to buy, right? Then maybe we've got something working here, and we might get a lead. We roll a break-even stop and wait. Here's what's going to happen. A half to 2/3 of your trades will be all scratches. And the one time you're on the right side when the toolbox called a low or called a high and you're able to hold it, you'll make money. You see what I'm saying? So really you have to be of the mindset that you're not trying to predict prices. What you're trying to do is shake hands with market structure. If the structure has really turned, in the case of Euro right now, if the market has really turned from seller to buyer, the structure is now bid. If that's true, the toolbox is going to find some great places to buy it on the higher time frame. So just wait for it to show up. Quite frankly, I think right now at 130.90 is perfect. In fact, I bought it yesterday right here at 130.95 on this dip. Scratch trade. You know, I got about a 40-point lead on it. 50 points, rolled a break even. Market came down, took me out. Now we're getting more signals at around the same area. I'll buy it again. Right? That may turn out in 2 or 3 or 4 days from now, over the weekend, that may turn out to be a great trade. So on a 60-minute time frame, yeah, trying to get a little bit of a lead here. Not quite happening all the way yet, but we're getting some good congruence here. Markets may be turning bid. That doesn't mean you can ignore the sell side or you don't have to trade it. I'm just saying if you're still bearish and you really think Euro's going to make a press for a new low, fine. The toolbox will help you find a sell signal. But when you find it, what you're looking for is congruence. You want to see it on more than one time frame. Now, with regards to conflict, let's look at the opposite side. Now, I want you to remember, because now when we're looking at lower time frames, there's some things that you have to understand. First of all, you know, this is a 60-minute time frame. Between each of these vertical lines is 24 hours, right? So, looking over here at the buy side, at this point, you know, we'd have to go back a week on the 5-minute chart to see if that was congruent with sell signals. So I'm going to look right here. You notice that lately, in this price area, we're starting to see buy signals as the market comes down from the high print down into this area here at 30.50 to 30.90, right? We're starting to see buy signals on a higher time frame. So now if we look down at the 5-minute chart, from these high prints, we're starting to see sell signals coming on that are more in conflict. You'll notice the buy signals coming on too that aren't working. The sell signals are working, the buy signals aren't. Sell signals are working. And if we go back here, as the market will go higher and higher in price, remember we're, 5 minutes it's a long time to get through a whole day here. The sell side is more active. There's very few buy signals, few and far between. The sell side is more active, right? Every now and then you get some good quality 5-minute buy signals at the reversal points. But here's what I want you to notice. As we get back over here, as the market's starting to make highs, like it did earlier in the week at around 31.60 to 31.80 area, look at how many buy signals were right at the high. The sell signals were being negated as the market went into the highs, right? Here we are at the highs again. We got buy signals as the market's coming down, right? What I'm hoping to help you understand is that on a 5-minute time frame, it doesn't give you a lot of help when it comes to buying or selling for a 5-minute time frame. What it basically does is tell you that you're getting lots more buy signals than sell signals as the market goes into a high print, and the high time frames say you might want to be a seller or you might want to just wait. The 5-minute saying go long. When the market is selling off, right, and that you're still getting buy signals now on the 5-minute. Then when it starts to reach the area where the 180, the 120, the 60-minute is saying you might want to be a buyer, now the market is getting lots of sell signals. Lots of sell signals coming on as the market reaches into the low prints, right? Now I'm not saying, like I said, here's an H reversal. On a 5-minute time frame, the toolbox called the absolute low for the week so far. For the day so far, right? That's great, but the toolbox is less accurate on a 5-minute time frame for those kind of trades. It's more accurate by looking at it a bigger picture. If you look at the toolbox on a 5-minute time frame over, say, 6 or 8 hours and compare the number of signals on one side or the other to what you're seeing on the 60, 120, 180, and 240, what you're likely to see is conflict. That when you're seeing buy signals on the daily 240, 180, 120, 60, and then you go all the way down to the 5-minute chart, you're going to see a lot more sell signals. If you're seeing a lot more sell signals than buy signals as the market's coming down, that's usually a good sign that the market's about ready to bottom. You follow me? Let's go back. We can look at the 15 minutes, same concept. See, 15 minutes saying sell, 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 and here we are right about the low prints. And this is right in this area is where the big time frame is saying be a buyer, right in here. 30-minute. Again, this is good conflict. The market's coming down. It's showing buy signals that aren't working. Now the sell signals are coming on. They're late. You know what I mean? Okay, now, that's the basics of conflict and congruence. So I want to open the door up to any questions here and maybe answer a few that might be more along the lines of understanding the relationship between conflict and congruence. Now, again, there's nothing that's 100%. It's a concept. You got to think of it in terms of concept. Okay, Howard's got a question here. Howard wants to know, how do you know big time frames are buying? Okay, Howard, I'm gonna throw something out to you here. I don't know how this is going to land in your hearing, and it's not my intention to insult you, but that's the wrong question to ask. Okay, and I don't mean this in a negative way at all. This is what I teach in my Psychology of Trading course. In my Psychology of Trading course, what I teach is the relationship between the normal everyday thinking process that we as traders bring to the table when we're uneducated, unenlightened, or still growing. Once we have had that aha moment about what this business is really all about, when you get to that point, you're creating a new paradigm of thinking. And that new paradigm of thought is going to be more in line or more congruent with how the market thinks already. The reason the market moves in price, it has to do with the fact that the loser is on the wrong side of the market and he has to liquidate. Price movement is liquidation. The important issue here to say, how do you know large time framers are buying? That's the wrong question to ask, because we don't know. When you ask the question, how do you know, you're using your pre-existing paradigm of thought that involves the need for certainty. In the marketplace, there is no certainty. In the rest of the world, or in the real world paradigm, and like I said, I teach this in my Psychology of Trading course, it's very common for us to need, want, or expect certainty, right? If I shake hands with you and we reach a deal, I'm expecting that deal to be done. It's certain, right? If I make my car payment every month, it's my car. I'm certain of that. I'm not going to, I don't have to expect that someone's going to knock on my door and repossess my car, because we made an agreement and we have a deal, and that's the way things work. There's a sense of certainty, right? If I go to work and exchange 40 hours of my time this week, I'm going to get a paycheck. That's a certainty, right? So in the real world, the world that has to do with getting through day to day with friends, family, relationships, and our normal everyday life, as we call it, a sense of certainty is normal. It's typical. We can expect it to be there. But in the marketplace, you're not dealing with certainties. You're dealing with probabilities. Nobody knows what someone's going to do until they actually do it. So we don't know if anyone is buying the marketplace at those price levels. But there are clues that the probability is higher at that point that they will buy it. For example, to give you an idea about probability, and we talk about this, I talk about this in my book, Time Compression Trading, that the winning trader, the guy that makes money all the time, is thinking in terms of probabilities, whereas the losing trader is always thinking in terms of certainties. In other words, the losing trader is looking for a sense of certainty when he trades. He wants to know that something's going to happen before he does it. And that is one of the reasons why losing traders wait for confirmation, because they want to be a buyer, but in order for it to make sense to them, to be certain in their mind that it's time to buy, the market's got to already be moving higher. Well, if you understood market structure at that point, the higher the market goes, the more likely of a reversal. So by the time a losing trader sees a buy point and then waits for confirmation, that's only confirmation in his head. It has nothing to do with the structure of the market. So he waits to buy until the market probability is going the other way now. That's why it's typical for how many traders have done this. You see a trade, you know you want to buy, you wait until it's confirmed, then you buy. 2 seconds later, the market goes the other way. The reason that's happening is because the structure is not based on real-world thinking. The structure in the market is based on the actual order flow of who's on the buy side and who's on the sell side. Since the losing trader is always liquidating at a loss, what we're looking for is how does the loser think? Well, if the loser is thinking, I'm going to wait for certainty before I buy on a 5-minute time frame, he's going to wait 4 or 5 bars. So we know at the end, the market puts in a low print and rises, he's going to buy it 20 minutes later, time to sell. It's that simple. It really is. So when you ask the question, how do I know that the long time frame guys are buying there? I don't know. I don't need to know. What I know is that that area at that moment in time is a higher probability that a larger time frame trader would want to buy there. So if they show up, their buy orders would normally be larger than the sell orders from the late seller that's a small time frame trader. If that's the actual market structure, the price will rise. So we're looking for a place where the market has good probability of a change in the order flow between the competing time frames. And as you can see right now, that's exactly what you should have done, is bought euro right there. And that was on the 180 time frame, said you need to be a buyer, right? Perfect. If I wasn't on the air with you, I would have bought it right there at 130, 90, 95. I'd already be long, you know. You see what I'm saying? So I'm not saying that to discourage you, because we don't know, Howard. There's no way to know. Howard says, I haven't been an engineer, that's my background. Okay, perfect. You could not have said something better. I'll tell you why. One of the things I teach in my psychology of trading course, the exact same thing, is that people who have a real-world paradigm bring that to the table when they trade. So a guy who's an engineer, it makes perfect sense to think that the markets are financially, or the financial markets or the markets themselves, because they're using numbers for valuation, it's very common for him to think that there's a numerical coefficient and relationship to that. You know, that if we do a certain, it's very attractive to use high-level math, things like calculus and whatnot, to polynomial equations and all the rest, to find things like, you know, support or resistance. That's very attractive because that has served you well with, you know, designing circuit boards and making brake pads that will last longer, right? And making sure that the bridge won't fall down after it's built, you know? So in the real world, numerical combinations help you achieve a sense of certainty. You could say with degree of certainty that that bridge will stand up and the other one won't. So you spend 30 years doing that, and then you start trading, it's going to seem really common, very normal for you to think that the markets could be expressed mathematically, right? When in fact they can't. But most people aren't aware of that, see? They don't understand that there is a real-world paradigm that interferes with their trading paradigm and interferes with their making money. And I talk about, in fact, on my Psychology of Trading page on the website, there's an introduction to the material. What I call, what I just described there, the real-world paradigm, that has to do with what I call cultural myth and self-sabotage. The relationship we have, what we're being taught as people in the real world has nothing to do with making money in the markets, and we're unaware of that. And so it's very common for us to reach conclusions and decisions about what we're doing and place trades for reasons that have nothing to do with the underlying structure. You see what I'm saying? So that's what the toolbox is trying to do. That's what's different about the toolbox compared to other methods of analysis, is it knows that about people. And it knows that usually, most likely, people are going to be buying and selling at the wrong points for the wrong reasons. So it's trying to find a time and a place where mathematically that could be expressed. That's the buy side and the sell side signals. Nikolai says, what if to take partly small profit with big stops and make break even, it may be more probable profit trading? I mean by the toolbox. Nikolai, I'm not sure I understand this. What if to take partly small profit with big stops and make break even, it may be more probable profit trading? You might have to rephrase that. I'm not quite sure I understand what you're saying there. And I think, Nikolai, I don't think English is your first language anyway, I think, right? I think you're Russian. Maybe you could rephrase that. I think what you're trying to say is that if you take small profits with big stops, that might be better than to just roll a break-even stop, which it depends. You know, it's your call. Always remember this, guys, and this is another thing I teach in the psych course, is every time you make a decision because you see a probability or something that enhances your potential, whatever that is, there's a negative downside to it, right? In other words, if you say, well, I think what I'm going to do is I'm going to scale into a position and scale out of a position. Okay, if you do that to help maintain profitability and reduce your risk, the downside of that is there's another downside to that. The downside to that is there's going to be a handful of trades that never allow you to scale. And if you scale out of positions, you have to allow the market to go farther to make up for the net difference of your losses that you scale out of, which I know may sound confusing at first, but it's not. What I'm saying is that if you take all your losses 100 points, then you put a 3-lot on and you take one off at 20-point gain, another one off at 40-point gain. In order for the next one to make real money, that one lot has to go twice as far. So when you scale out of a position, you're actually robbing yourself of profitability. What you should be is adding to the position. You should be pyramiding. You see what I'm saying? But it's, again, that's all based on, you know, what people crunch numbers and say, well, this is what you should do, when professional traders will say the exact opposite is where the money is, you know. You might want to rephrase that. Any other questions you guys have got here? Because these are great questions. I just want to make sure we're on the same page. Now, a couple of things I want to share with you, because some of you guys are trading other markets. I've got crude oil up here. This is crude oil, and I put on, you know, volume underneath the 120 minute in this case, 60 minute. And oops, let's move this to here. And I use volume in addition to the toolbox when trying to get positioned. Here in crude oil, I wanted to show you this real quick on a 60-minute time frame. There are some really strong signals in crude oil here recently. If we look back here on the 10th, you'll notice that we had this little blue diamond right here and this little blue diamond right there. Let me open this up a little bit here. I just wanted to show this to you real quick. See the blue diamond there and the blue diamond there? On the TradeStation, MT4, and multi-charts, that's an E. It's called an exhaustion reversal. Should be an E, blue E, or just an E. When the E shows up, or the blue diamond shows up, that is one of the most high probability signals that the toolbox generates. Here we have a cluster of sell signals in a 12-hour period of time. You know, we've had 3 or 4 in a 16, 20-hour period of time, really. And we have these clusters of H reversals and blue diamonds. Now, in this case, the market only gave you a lead from, you know, the 106, 107 area down to 104. That's $3 a barrel. That's not a huge move, but again, it's reliable to give you a lead. If you're looking for a top in the market, there was a $3 a barrel lead right there. It turned out that it wasn't the top. You know, the market came right back again, and some buy signals along the way that were kind of negated too. And then, you know, so it's really up to you to decide, you know, if you want to be bullish or bearish. But I wanted to show you those signals there because on this is crude oil now. The toolbox will work just as well. If you have, like here, this is the S&P, you know, which you guys could, you know, we could also say is the E-mini. We could put the E-mini chart up here. It's basically identical. And you could use the toolbox on the E-mini as well. You know, so if you're an E-mini trader and you like to trade the E-mini, you know, there's lots of opportunity that's developing using the toolbox. And again, it's your call how you want to trade it. You want to trade it looking for a top, it'll give you a lead, or try to give you a lead. If you want to go with the trend, it'll give you some great places to buy, right? And again, your recommended stops, these are really wide. If you want to take this much heat, trade a mini then, you know, it's up to you. I just wanted to share those out there with you to let you know that if you're trading in futures, options, Forex, the toolbox can help you in any of those markets. Here's a dollar index on a 60-minute time frame. You know, you can see that the toolbox has got some good quality signals on both sides. On a 60-minute, on a 120, it's had some good signals this week as well from the top side. On the daily, you know, on the daily, since you know, the beginning of the year, almost every top of the range has had a lead. Some nice gains too. Of course, you could also buy it from the bottom side too. One client I talked to uses a 120-minute time frame, and he trades X to X. He waits for a sell signal X to come on, he sells it, and then he waits for the buy side X to come on, covers his short, and goes long. You know, he makes money net most of the time. He ignores everything else in between. He doesn't take any of these other signals to cover or enhance his position or anything. You know, so it's your call how you want to use the signals, but you know, I'll give you some help on it and really help you understand the relationship of conflict and congruence if you want to get a copy. If you don't have a copy now and you get a copy, I'll always train you on it if you ask. All you got to do is ask, and I'll work with you a little more closely, and I'll give you some help on understanding conflict, congruence, how to settle on a time frame that's going to work for you in your thinking process. It'll be a great clue to help you. Okay, let's see. A couple of extra questions coming in here. Clark says, do you factor in volume when trading Forex? Well, actually, Clark, what I would do is this. I have it up here just in case you wanted to see it. Here's British Pound Futures. And you can see I got volume on a 60-minute time frame up underneath it. I use futures volume as a facsimile for what's going on in cash because they are the same market. So I would look at this little spike higher here where the sell signal came on high volume, and I would say, well, it's a little bit more risky to sell it, but high volume. Now we have a low volume spike. See this volume here? That high volume, the high volume bar here to a high for the week was followed by another high for the week on lower volume. That typically means the move is over. So there's your pullback. That pullback was 100 points. You know, was that enough? You don't really see a top in place on the higher time frames. But if we look at the 5-minute chart and we look at yesterday's big move, there it is right there, right? Nothing up there, and it's still saying buy as the market comes down. You know, that's good conflict. Yeah, look at this. On a 5-minute time frame, blue diamonds and X reversals clustered together at the 150-169 area. You know, if we look on the 60-minute again, 151.60 area, that was the bottom right here. Yeah, so yeah, it's, I don't know, man. I don't know if I'd use a 5-minute chart to get position, but definitely some signals there. Anyway, to answer your question, I use volume on futures as a facsimile for volume in cash. Okay, Mario's got a question here. He says, I notice signals are more reliable in some periods like now and less reliable like last month. Is it possible to know when are the highest probability for good signals? Well, the answer to that question has to do with understanding how the signals are created. The signals are, the reversal signals are reversal signals. The trend signals are trend signals. When a market is in a range and it's trading in the same general area, back and forth, back and forth, back and forth, back and forth, the trend signals are not reliable at all. So you want to ignore them. So you get in a market that's in a trend, you want to ignore a range consolidation. You want to ignore the trend signals. They'll be right in the middle somewhere. The reversal signals on either end of the range could be very reliable, right? So that's maybe what's happening in Euro right now. We may be topping here in a range, and the buy signals or sell signals might be a little less reliable, but the reversals might be more reliable. A move down to the middle of the range and then test the bottom of the low here, that would not be uncommon if it really was a 2013 low. So, if we get another X reversal or H reversal, the market climbs back to the 132 handle, we get another X or H reversal, that may be all that's in this long. You know what I'm saying? So when you say reliable, you got to remember how they're structured. And you have to look at the overall price action as well. The reversals are reversals. The trends are trends. If the market is in range, then, covering the same ground twice, 2 or 3 times, then the trend signals are not going to be reliable at all. So, yes, they're less reliable in a range, so you wouldn't want to use them. However, the reversals are still very reliable. So it might be to your advantage to remember that in addition to looking at just the signals, you got to kind of scale out a little bit and look at what's going on in the bigger picture. Maybe there's a range that's very wide. It might be 400 points wide. So on a 5 or a 15-minute chart, the market looks like it's trending like a ski slope, and when all it's really doing is going from the middle of the range back to the top of the range over a 4-day period of time. Once it gets to the top of the range, you get a reversal pattern on a 60, 120, 180, and the market starts to decline. On a 5-minute time frame, it's going to look like it's trending like a ski slope all the way down to the bottom over 400 points in a week and a half. So what is a trend? What is a range? It's been on your point of view, and that may mean that that's more or less reliable on the time frame for the signal. So you got to kind of use it in context. Clark says, why use futures volume as opposed to volume indicator and MT4? Well, the volume indicator in MT4, as I understand it, has to do with the volume that's going through that particular brokerage house at that particular price level. Well, there's no broker that's got a big enough slice of the market to make it look, to be as accurate. Futures, there's only, that's one market. And that is, the Chicago Mercantile Exchange for the most part. They're the largest, deepest, thickest futures contract for foreign exchange. The world standard and the world industry standard. So whatever's going on in futures most likely reflects cash a lot more accurately than any one broker's MT4 platform. So that's why I wouldn't use it as much. But that's me. I'm not saying that everybody would agree with that. Okay, so bottom line. Here's some basics you want to always remember about using the toolbox. The most accurate trend signals are clusters and stacked. Now, I think I showed you that real quick here. This is a cluster, right? And a stacked signal is, where do we see a stacked? Oh, on the daily I saw a stacked. Kind of hard to see because of my notes here, but if you look right here, let's open this up a little bit. Okay, these are stacked signals right here. A stacked signal is when you get a strong trend and a regular trend on the same bar. That's a stacked signal. We'll also get those on reversal patterns, but those are not as common. I think we saw one of those on the yen or the euro 180, I think. No, maybe it was the 240. No, must have been another chart. Okay. Oftentimes a reversal pattern will have, like this H will have an X above it, or you'll have a blue diamond with an X or a blue diamond with an H. Very rarely will you get HX with a blue diamond, HX and E. But in any case, the point I'm making is that stacked signals and clustered signals are more reliable. Like here's a sell signal out here all on its own. that's less reliable than a buy signal that's like out of 6 bars, 4 of them have got a signal working. You know what I mean? The most beneficial reversals are the the exponential reversals, the X reversals. The X reversals have a very high probability, above 60%, and they are the most common ones. You'll see X's more often than H's. H's tend to cluster, and they're always tested, almost always. H reversals happen, and you get another 2 or 3 right behind it in a few bars, and then finally the bottom comes in. And when the bottom's finally in, a lot of times it's an X and an H together, or just an X. So a lot of clients just ignore the H reversals and go with the X's. You know what I mean? E reversals, which are exhaustion reversals, those are called blue diamonds. Exhaustion reversals are blue diamonds on the Trade Navigator. Those are rare. You don't see those very often. I mean, in one market, you know, like in a 60-minute time frame, you might get 3 or 4 of them in a year. But when they show up, they're like 90% accurate. It's time to load for bear. You get a lead on that. You get a lead on that signal all the time. Sometimes that lead turns out to be the corner in the market for 90 days. You know, like that's a bottom or a top for the next 90 days. So, I mean, if you see a blue diamond or an E reversal show up, you want to put a lot of confidence in that. Be ready to take it and maybe trade a little bit larger on it. That would be my suggestion. Reversals, those can be signals to close trend trades. You know, if you want to use them that way. I personally don't like to use them that way. I like to use them to put new trades on. I like to use them as warning signals, but I don't close out my long if a short reversal shows up. Late trend signals are often negated. I don't know if you noticed this, but when the market was reaching a top in some of those illustrations, there were some trend buy signals, but all of a sudden you get a lot of blue boxes behind it. That means that the trend signals are late. They're being negated. There's something wrong with them. So if you get a reversal pattern up near some important high print, like the monthly high, right, or the quarterly high, and you're getting good reversal signals on a 60, 120, 180, 240, and then the market comes down a little bit, and you get a buy signal, and the market comes up just a little bit, and then starts making a new low, and you get a buy signal again, and then a reversal, and then a reversal and negation, right? That's a real good clue that you could add to that position, because that reversal is probably more accurate. You're getting trend signals that are late. Okay, here's my contact information. We might have 1 or 2 more questions left over. I want to give you new guys a chance to get in touch with me. You know, I want you to consider me your friend in the business. I'm always available. Here's my Skype handle for you guys that might be overseas, or if you just want to make a quick phone call to me free for some reason, feel free. I'm on Twitter. I post my trades on Twitter. I have a YouTube channel. All the videos on my website are also on my YouTube channel. They're all linked together. Here's my telephone number. If you're local or in the States or just want to use a phone call, you can make a phone call. I'm the only guy in this industry who still answers his own phone. Here's my website, email address. Every Friday, I do a weekly wrap-up of my trading. I'll show you exactly how I use the toolbox this week, win, lose, or draw. You can sign up for that webinar on my website. All you got to do is go to the My Trading Performance tab. It's all the details are there. For those of you that have my Apple iPhone app, Forex EDU, thank you. It was #1 in Singapore and Greece this week, according to my iPhone app developer who manages the stats. So for those of you that have the app and help me get there, maybe you're from overseas, thank you. If you don't have the app, it's free. Just download it for free. There's free content in there. There's also some pay-as-you-go content. So you might enjoy that just to have it. Let's see. Also, if you're interested in learning more, you can go to codefortraders.com. You can go to the PTT section of my website. And if you just bought the toolbox and you'd like a little bit more extra help with it, feel free to get in touch with me anytime, and I'll work around our schedule here, and we'll see if we can't give you some private tutoring. Clark says, by the way, I read time compression last week and almost through trading rules that work. Really helpful and eye-opening. Thank you. You're welcome. I'm glad you like it. Clark, you might be a good candidate for my Psychology of Trading course. Actually, I'm going to be, the Q4 course is going to be moved up a month. And that's because I don't know if you guys knew this. I'm getting married in November, so I got to put a lot more time into that process than I had thought. And I won't be able to do the coursework in November, so I'm going to move it up to September and October instead of October and November. So sometime in the next few weeks, we're going to be doing the introduction, and I've got some testimonial webinars. Guys have bought the course and completed the course. I've got some things they want to share with you. So I got a couple of clients that would like to do some webinars to help you see the value of the course. And then we'll be doing it again for Q4 in September. So you might be a good student for that. You might be a good fit for you. A lot of times I read, guys that read my my books, have attended my webinars or lectures or working with me, once they begin to see the difference between trader management and market analysis, the light really starts to go on for them. I'm telling you, you can make a quantum leap in your trading and in your performance when you fully understand that. This business, Clark, is not about markets. The market is actually incidental. The market really has very little to do with how we win and how we make consistent gains. And when you understand that, really fully own that, and it's deep inside your thinking, and you're modifying your beliefs to take advantage of that, man, you are going to make so much more success happen for yourself than you probably can imagine. It's not that hard to win. It's work to stay a winner. And that's what I teach in the site course. I help people understand what has to happen in order to be a successful trader is different than what we originally taught and what we think is like our natural understanding. Once you fully grasp that and you begin putting it in real terms for yourself that you can own and enforce, your trading takes off. And I'd love to see you have that opportunity. So the Psychology of Trading course is designed to help you with that. And hopefully you'll want to consider it. I hope you do. So I'm very interested. Already completely changed my perspective. Good. Well, I'm telling you, if you're thinking that way, when we do it here in September, we're going to do the 6-week course starting in September for Q4 instead of October. It might really be a good fit for you. So let's keep in touch with that and make sure you get a chance to attend all the introductions and maybe a handful of the testimonial and referral webinars we're going to be doing with some students that have wanted to volunteer their time. Promise you'll like it. Okay, any other comments or questions, guys? Great turnout today. We're about the 1 hour mark, maybe a little longer, so I want to go ahead and let you guys get back to your day. I'll have this recording posted to my website shortly. Any other last minute questions? And for you guys that don't own a copy of the Toolbox yet, that's okay. All you got to do is get in touch with me if you're interested, and I'll do my best to hook you up with whatever is the platform you want to run on and point you in the right direction. And again, if you just recently bought the Toolbox and you're interested in learning a little bit more and getting some, maybe more closer one-on-one training, just get in touch with me and I'll hook you up. Okay, a couple more thanks and great training and all that good kind of stuff coming in. Good. All right, guys, thank you. I guess we're done for today. Listen, thanks again for coming. My pleasure to work with you. I'll keep you posted via email with what's coming up next. I'll make sure everybody that attended today is in my database, so you'll get a chance to know about all the new stuff I got coming up when it comes up. And again, think of me as your friend in the business. Anything you can do to help, feel free to get a hold of me. Here's my contact information, and I'll have this recording up for you shortly, so if you'd like to review it or hear something again, you're going to be able to do that quickly. So thanks again for coming, guys. I'll see you next time. Have a great day.